The assets that a company owns can have a longer lifespan than just a year or an accounting period, and this is going to be known as a long-term asset. If the asset is something that is tangible that the company is using for its operations, like equipment or machinery, this is going to be known as a plant asset. There are a lot of different components we have to account for when it comes to our plant assets. First, your cost. Any expenditures you make in order to get that asset set and ready for use will factor into its cost. For our machinery and equipment, costs will also include taxes, insurance for while the asset is in transit, and installation. A building that a company uses for its operations will have lawyer fees, title fees, and taxes included in its cost. Any additions to our land is going to be known as a land improvement. So that could be a driveway, a fence, a sidewalk, parking lot, and these are going to have a limited life. Any cost to make that land improvement ready will funnel into its cost. Land is our asset with an indefinite lifetime. There are a bunch of costs that go into accounting for your land, such as cost of land, legal and title fees, real estate commissions, and any payments you have to make to clear the land, for example. A company can buy a bundle of these plant assets in something we call a lump sum purchase. Let's do an example. If I own a hair salon and I bought a building and then salon equipment for a lump sum of $150,000, I would allocate the cost for these assets based off their appraised value. So for this scenario, let's say my building's appraised value is $120 and then the salon equipment's value is $60,000. Together, they would equal $180,000 if you just added their values together, but my lump sum is having me pay $30,000 less. How? Take the appraised value of the asset and multiply it by the percent of the total that it makes up. So $120,000 divided by $180,000 gets you about 66.67%, and $60,000 divided by $180,000 gets you about 33.33%. Apply these percentages now to the lump sum of the cost to get the cost for that asset. 67.67% of $150,000 values the building at about $100,005, but for the sake of clean numbers, we are going to say $100,000. And we do the same for our salon equipment and round up to a clean number just for the sake of our example to get those valued at $50,000. Now in our journal entry to account for the lump sum, we would debit our new building by $100,000, our salon equipment by $50,000, and credit cash by our lump sum amount. As always, make sure your debits equal your credits, and in this case, they do. We all know that as soon as you race your car off the dealership's lot, it will lose value, and this is known as depreciation. We allocate the cost of our plant asset to an expense as it is depreciated while it is being used. Our depreciation expense will be defined using the cost, the salvage value, and then the useful life of that asset. Salvage value is the value we are salvaging of our asset once its useful life is over. Useful life does not have to equal total productive life. It is just the time frame of which the asset is used for our company's operations. There are several ways we can calculate for depreciation expense, and our first method is the straight line depreciation method. This is the simplest formula for depreciation, where you just take your cost minus your salvage value and divide it by the useful life of the asset, and this is going to be the fixed amount with which your asset depreciates annually. In a journal entry, we would debit our depreciation expense and credit the contra asset accumulated depreciation of our asset. Our second method is better for when the use of the plant asset varies between accounting periods. The units of production depreciation will find the depreciation of the asset based off its actual usage that can vary from time to time. First, you would compute the depreciation per unit by subtracting your salvage value from your cost and dividing by the forecasted units produced during the asset's useful life. If the asset we are computing for is a truck, then you're dividing by the expected miles that truck will have driven by the end of its useful life. Your units can be anything. Second step is taking your depreciation per unit and multiplying by the units produced during that accounting period. This is your depreciation expense. Probably the most complicated out of the three is the declining depreciation method, which will calculate the depreciation of the asset when depreciation is higher in its earlier years and depreciation is lower in its later years. First, we would compute the straight line depreciation rate by taking 100% and dividing by the asset's useful life. Now double that rate and apply it to the asset's book value at the beginning of that period. As the years go by, the asset's depreciation rate under this method is going to get smaller because you are taking a percentage of book value that is depreciating each year and using that as your new depreciation. If we buy or sell an asset when it's not the beginning or the end of the accounting period, we have to account for its partial depreciation. If I bought salon equipment in February and then my accounting period ends in April, I have to account for the partial depreciation for those 2 months. Use your straight line depreciation and multiply by the number of months the asset was used divided by total months in a year to get your partial depreciation. Our salvage value and our useful life are estimated. A company will make these estimates reasonable, but sometimes they have to change their estimates, and this is going to change our depreciation. But we do not apply this change to our past depreciation expense journal entries. You will only be showing this change in your current and future financial statements. Our straight line depreciation will still be pretty much the same. You're just going to take your revised salvage value and your revised useful life. Not every cost related to a long-term asset is treated the same way. A capital expenditure is a cost that benefits more than one accounting period and will increase our asset's useful life, efficiency, or capacity, so we add them to the book value. A betterment is an example of a capital expenditure because we are spending money to make that asset more efficient or productive. Extraordinary repairs are also going to be capital expenditures because these are repairs that are going to extend the useful life significantly. A revenue expenditure will not increase the asset's life or capacity, so it will be expensed as usual. Ordinary repairs are just as they sound. They will be done routinely to make sure the plant asset is operating well. These are revenue expenditures, so they will be expensed immediately. Eventually, a company will dispose of plant assets by either selling or scrapping them. An asset has fully depreciated when its book value equals its salvage value. If I sell the asset but the cash received is less than the asset's book value, the company records that loss with a debit. But if the cash received equals the asset's book value, there is no gain or loss, and my cash and accumulated depreciation are my only debits. If the cash received is greater than the book value, the company records a gain with a credit because this is seen like a revenue. Oil, coal, timber, minerals, these are all natural resources that are physically consumed, and so they are going to deplete. Depletion allocates the cost of natural resources over the units extracted. To calculate depletion per unit, take your cost minus salvage value and divide by the estimated total capacity. That depletion per unit is multiplied by the units extracted during the period, and this is your depletion expense. Our machinery and our equipment are tangible assets, but a company can also have intangible assets that they own and that have value. A patent is an intangible asset that's giving you exclusive rights for your invention. Copyright protects your creative inventions like books, music, or videos. A trademark will protect your brand name, logos, or symbols. Goodwill is a representation of a company's reputation and its customer loyalty. And then to use an asset, we can create a contractual agreement known as a lease. Very similar to straight line depreciation, amortization will allocate the cost of an intangible asset over its useful life. Now let's calculate our total asset turnover. This ratio will measure how effectively a company uses its assets to make a revenue. So take net sales and divide by your total average assets to get your ratio. A higher ratio means that the company is using its assets more efficiently. That was a lot of methods and definitions just thrown at you, so go down below to study with my free downloadable study guide and use it to help you on my free practice worksheet. And don't forget to like and subscribe for more content.